Realized return. Realized return is a return on which you owe taxes. So unrealized return is paper profits only. You don't owe taxes on paper profits only. Holding period return. It's possible that you held an investment, it says, for 10 years, and you had a holding period return of $50, of 50%. Holding period return. And you held this investment, it says, for 10 years. So the best measurement of return over a holding period is the security's holding period return, or the portfolio's holding period return. But there might be another investment that you held for 6 months that had a return of 5%. And the question is, which one of these is better? How do we compare two different holding periods? You really can't. So what you need to do is you need to annualize them. An annualized return is best for comparison purposes. An annualized return is best for comparison purposes. So if we had a 50% holding period return, but we held the investment for 10 years, our annualized return would be 5%. Anytime your holding period is longer than a year, the annualized return is always less than the holding period return. Anytime your holding period is longer than a year, your annualized return is always less. That's an important truism. They like it on the test. Here we have a holding period of 6 months. So to annualize this return, we have to multiply it by 2. So the annualized return here is 10%. So obviously, this one's better. Anytime your holding period is less than a year, your annualized return is always more than your holding period return. So those are two important truisms. They like them on the test. So annualized return is the best measurement of return for comparison purposes. The time-weighted rate of return is a measure of the compound rate of growth in a portfolio. It is often used to compare the returns of investment managers since it eliminates the distorting effects created by the inflows of new money. It is also called the geometric mean return. Dollar-weighted return. The rate of return that would make the present value of future cash flows plus the final market value of an investment or business opportunity equal the current market price of the investment or opportunity. In other words, the rate of return at which the net present value of the project is 0. We talked about this, the internal rate of return. If the internal rate of return exceeds the cost of financing the project, then the project is viable. We've discussed this. The internal rate of return is also useful in ranking competing investment projects. The higher the internal rate of return, the better the project is. The rule of 72. Have you heard of the magic number? 72. The rule of 72 can be used to help us determine one of two things. It can help us determine the rate of return necessary in order for our money to double. For example, 72 is the numerator. The denominator, let's say, it says you're going to invest $5,000 for 10 years. The question says. And the question is, what will the rate of return need to be in order for your $5,000 to double during your holding period? What would the rate of return for the investment need to be in order for your investment to double? So 72 is always in the numerator, and in this case, we are given the holding period of 10 years. So 72 divided by 10. In order for my $5,000 to be worth in 10 years, twice as much, the investment would need to earn 7.2%. So the rule of 72 can sometimes help you answer. There's questions on the test where you go, I don't have a financial calculator. I'm not really sure how to get to the right answer here. Use the rule of 72. Another way that they could say it, they could say that the rate of return on the investment is 10%. The rate of return is 10%. How long will it take your investment to double? How long will it take your $50,000 to be worth $100,000? So using the rule of 72. 72, this time we're going to divide by the rate of return. It will take your money 7.2 years. 7.2 years to double. So, it's kind of cool. A lot of times advertisements for investments, generally mutual funds, will show people, clients, average people that you're going to run into don't understand how investments work. So the rule of 72 is used for illustrative purposes to show them how long it would take if they were able to earn 10%. How long would it take them for their money to double? 7.2 years. Benchmark portfolios. A benchmark portfolio is a predetermined set of securities that's used for comparison purposes. Very oftentimes, investment advisors of a mutual fund, they're actively managing the fund. And if they beat the benchmark index, very oftentimes we pay them a bonus. So an index fund mirrors an index, subject to a little bit of tracking error, but all that investment advisor would do would want to recreate the index within the portfolio. So not actively managed, an index fund. Where if you have a benchmark, it's mostly used as something to measure how good is this active manager doing. Did they beat the benchmark? I mean, if they didn't beat the benchmark, then why are we paying them? That's the idea, and very oftentimes compensation bonuses are tied into beating a benchmark. Market capitalization. Market capitalization is the company's share price times the number of shares outstanding, the number of shares that are in the hands of the public. Always a definition question on market capitalization. So share price times number of shares outstanding. So the share price does vary every single day. How many shares are in the hands of the public only changes if the company sells more shares. So you've heard the term small cap, mid cap, large cap. But I'm going to show you a chart. I want you to use this chart in determining the answers for a question on the test. I'll give you an example. It is true that over time, the numbers in this chart go up because of inflation. So what was large cap at one point is no longer large cap. Maybe it's now mid cap. So over time, this chart changes, but I do want you to use this chart for your test examination purposes. So we're going to talk about the different types of market cap. So we have nano cap, micro cap, small cap, mid cap, large cap, and mega. It's like this super huge Starbucks drink that you can get nowadays. So it's like going to Circle K at Starbucks. I can't believe how big the cups get. Same idea. So nano cap. A nano cap company is a company that has a market capitalization of less than 50 million. Nano. A microcap company has a market capitalization of 50 million to 300 million. A small cap company has a market capitalization of 300 million to 2 billion. That doesn't sound very small, but hey, it's the small capitalization these days. Mid-cap is a company that has a market capitalization of 2 billion to 10 billion. Large cap companies have a market capitalization of 10 billion to 200 billion. And the megas are 200 billion and above. 200 billion and above. So there's a good handful of companies that fall here in mega cap land, if you will. So the test question says the company has a market capitalization of 400 million. 400 million. So you have to answer, what is it? The question asked, was it a small cap, micro cap, mid cap, or large cap? 400 million puts you in which of these categories? It's a small cap company. Generally, the smaller the capitalization of the company, the higher the risk. Smaller capitalization companies, their stock would be a growth stock. A growth stock. They would have low dividends, these growth stocks, and high PE. But you already know that. Indexing. The test wants you to have an understanding of the different indexes that are out there. There's hundreds of index mutual funds. There's open-end mutual funds. There's exchange-traded funds. Heck, there's probably thousands of index mutual funds out there these days. So if there are so many, we should know what are these different indexes. So the Dow Jones Industrial Average is the narrowest index that we ever reference, and it's actually the one that we talk about the most. The Dow is above 12,000. That's great. Or it's at 9,000. It's not so great. It's 30 large cap company stocks. 30 large cap stocks. That's it. So it's the narrowest index. So it doesn't tell us much, but we do talk a lot about it. I need you to know how is it weighted so that when there is a change in the Dow Jones Industrial Average, what makes it move more are the stocks within the Dow that have a higher price. So the stocks within the Dow that have a higher price are going to move the index more. It's a price-weighted index. So whichever share price of those 30 companies is the highest is going to move the index, have the ability to move the index the most. The NASDAQ Composite is an index of all of the stocks, including American depository receipts listed on the NASDAQ stock market. There's over 3,000 components. We talked about the NASDAQ is comprised primarily of technology companies and growth companies. So the NASDAQ Composite. The Russell 2000. The Russell 2000 is small cap companies. Definitely a test question on that. Small cap companies. The S&P 400. The S&P, Standard & Poor's 400 Index. This is mid-cap. S&P 500. This is the one we talk a lot about. This is large cap. So you know the S&P 500 is large cap. That one you know. You need to know how is the S&P 500 weighted. It's a capitalization weighted index, which is different from the Dow. The Dow was price weighted. The S&P 500 is capitalization weighted. So the companies within the S&P 500 that have a larger market capitalization will swing that index more. The S&P 600 is small cap companies. So it helps me if I think about it takes the most because the companies are the smallest. Because there's 400, 500, and 600. And you know 500's large cap. That one you already knew that. So 600 small cap. It takes the most companies because they're the smallest, which helps us remember that the 400 must be which one? It must be the mid cap index. So yes, questions on the test. The broadest index is the Wilshire 5000. Generally also a question on your test. The Wilshire 5000 is the broadest index. It used to have 5,000 components. Now it has more than 5,000 components. So it measures the performance of all U.S. equity securities. That concludes our discussion for client investment recommendations and strategies. This is a very important section on your test. So your score report, you want this area, you want a really high percentage here. Make sure that you practice the section quizzes. Email me if you're stuck on anything. Good luck.